Demystifying stock selection, financial analysis made easy. Picking stocks can feel like navigating a maze blindfolded. Fear not, financial analysis is your compass and map. It's simpler than you think. Imagine being able to look at a company's financials and understand its health. That's what we're aiming for. We'll break down complex jargon into bite-sized pieces. Think of it as learning a new language, the language of money. Just like learning any language, practice is key. Don't worry, we'll guide you step by step. By the end of this, you'll have the tools to make smarter investment choices. Financial analysis empowers you to make informed decisions, not shots in the dark. It's about understanding where a company stands financially and where it's headed. Think of it as peeking under the hood of a car before buying it. You want to ensure the engine is sound before hitting the road. Unveiling the power of financial ratios, PE, debt to equity, and ROE. Financial ratios are your secret weapons. They reveal a company's financial health and performance. These ratios are like vital signs, giving you a snapshot of the company's well-being. First up is the price-to-earnings ratio, or PE. This tells you how much investors are willing to pay for every dollar of a company's earnings. It's a measure of market expectations. A high PE could mean investors are optimistic about future growth, expecting higher earnings. Conversely, a low PE might indicate the stock is undervalued, or that the company is facing challenges. Next, we have the debt-to-equity ratio. It measures a company's financial leverage, showing the balance between debt and equity. A high ratio means the company is using more debt to finance its assets. This can be risky, especially in volatile markets. A low ratio suggests a stronger financial footing, indicating less reliance on borrowing. Finally, return on equity, or ROE, shows how efficiently a company generates profits from shareholders' investments. A higher ROE is generally better, as it means the company is using its resources effectively. It means the company is using its money effectively to generate returns, rewarding its investors. These ratios are powerful tools when used together, providing a multifaceted view of financial health. They paint a comprehensive picture of a company's financial health, helping you make informed decisions. Remember, no single ratio tells the whole story. Always consider the broader context. Unlocking financial statements. Finding and understanding key ratios. Financial statements can seem intimidating, but they hold the keys to unlocking a company's financial story. By understanding these documents, you can gain insights into the company's performance and potential. Don't worry, we'll guide you through the process step by step. These statements are publicly available, often on the company's website in the Investor Relations section. You can access them easily and start your analysis. The balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. It helps you understand the company's financial position. The income statement reveals a company's revenues, expenses, and profits over a period. This statement shows how well the company is generating profit. Lastly, the cash flow statement tracks the movement of cash both in and out of a company. It highlights the company's liquidity and cash management. To calculate the PE ratio, divide the company's current share price by its earnings per share. This ratio helps you gauge the market's expectations. The debt-to-equity ratio is calculated by dividing total debt by shareholder equity. It indicates the company's financial leverage and risk. To determine ROE, divide net income by shareholder equity. This ratio measures the company's profitability relative to equity. Understanding these ratios empowers you to make well-informed investment decisions. They provide a clearer picture of the company's financial health. Remember to compare these ratios over time and against industry peers for a comprehensive analysis. This approach ensures a more accurate evaluation. Mastering stock analysis, comparing companies for informed decisions. This process is essential for making well-informed investment choices. Comparing companies is crucial in stock selection. It helps you understand which company stands out in terms of performance and potential. Think of it as choosing between two restaurants. You wouldn't just pick one randomly. You'd consider the menu, ambiance, and reviews. Similarly, you should evaluate various aspects of companies. Similarly, analyze companies within the same industry. This helps you compare apples to apples. Look for companies with strong and consistent financial performance. Compare their PE ratios to gauge their valuation. A company with a lower PE ratio relative to its peers might be undervalued. This could indicate a potential investment opportunity. However, consider the growth prospects as well. A company with strong growth potential might justify a higher PE ratio. A high-growth company might justify a higher PE. Analyze the debt-to-equity ratios to understand the company's financial health. A company with a lower ratio is generally less risky. This can be a sign of financial stability. However, some industries inherently have higher debt levels. It's important to understand these industry-specific factors. It's essential to consider industry norms. This helps you make more accurate comparisons. Compare ROEs to gauge efficiency. A higher ROE indicates better management efficiency. A company with a consistently higher ROE is likely better at generating shareholder value. This is a key indicator of performance. By comparing companies using these ratios, you can identify potential investment opportunities. This method helps in making informed decisions. Remember, this is not a one-size-fits-all approach. Tailor your analysis to fit your investment strategy. Consider your risk tolerance and investment goals. This ensures your investments align with your financial objectives. Navigating common pitfalls, avoiding costly investment mistakes. Even with the best tools, investors can make mistakes. One common pitfall is focusing solely on past performance. Past returns are not indicative of future results. Remember, a company's financial health can change. Another mistake is ignoring the bigger picture. Don't get fixated on a single ratio. Consider the company's overall financial health, industry trends, and economic conditions. Don't be swayed by market hype. Emotional decisions can lead to costly mistakes. Diversification is key to managing risk. Don't put all your eggs in one basket. Spread your investments across different industries and asset classes. This mitigates the impact of a single investment going sour. By being aware of these pitfalls, you can navigate the stock market with greater confidence. Remember, investing is a marathon, not a sprint. Stay informed, stay disciplined, and stay focused on your long-term goals. Conclusion: empowering your investment journey with financial acumen. Financial analysis is not a mystical art, it's a learnable skill. By understanding key financial ratios and how to interpret them, you gain valuable insights into a company's financial health. Remember, knowledge is power. Start practicing today. Look up the financial statements of companies that interest you, calculate their PE ratios, debt-to-equity ratios, and ROEs. Compare them with industry peers. You'll be surprised by what you discover. As you become more comfortable, delve deeper into other financial metrics. The more you learn, the more confident you'll become in your investment decisions. Remember, every expert was once a beginner. Investing in yourself is the best investment you can make. Empower yourself with financial knowledge and watch your investment journey flourish.